Good afternoon, traders and investors. Will back here with another one, coming to you with a Wednesday market recap. Hopefully all of you had a very decent day of trading today. And in today's markets, guys, well, we actually ended the day green. Nice little bounce by the bulls after a more than favorable inflation report came out early this morning, which showed that after 4 months of inflation ticking to the upside, we finally got a print that showed that inflation was now curling back over to the downside. Now, of course, the fears in the markets currently are about future inflation, not about past inflation in the month of February. So there was still a little bit of skittishness, a little bit of anxiety in the markets this morning. But in terms of the technicals, it does appear as though the bulls are trying to form somewhat of a local rounding bottom. We had the volume climax on the Monday session, and now volume has been trending down as well. So is a little bit of the fear being alleviated? Well, you could definitely make that argument, especially coming out of deep extreme fear conditions, which on the Monday session read a 15 on the Fear and Greed Index. So in today's video, guys, we're going to take a look at a few things together. Number one, we're going to go over that CPI report, break it down into its different components, and get a sense of which components remain sticky and which ones are doing a lot better than expected. Number two, I have one earnings report that we will go over together. And of course, that is going to be Adobe, the biggest one of the day. We'll take a look at their earnings. They're down slightly in the after hours right now, about 3 to 4%. So we'll take a look at their earnings and I'll give my opinions as to whether or not Adobe could be a possibly good buy right now for a long-term portfolio, or maybe even a swing trade. Thereafter, of course, we're going to get into our major technical analysis of all our major sector rundowns, and then as well take a look at some big tech names, because we know today was a story about some very nice big tech bounces. So we'll take a look at the technical analysis there and determine whether or not these companies, even after these decent bounces, are they still good buys, or should we maybe still stay away? So a lot to cover in today's video, guys. Let's jump right into it, shall we? So the SPY up a nice 0.53%, the QQQs up 1.13%, but overall it was not a broad market bounce. A lot of the bounce was done by big tech and software. Most of the Magnificent Seven names were up, except for Apple, as it deals with the recent headlines we've had in the last few days about the watches being down, the iPhone sales projections being down from 5% year over year to about 2% year over year, and the bottom half of the market after CNBC told everybody to rotate to defensive and value names on the Monday session. That was actually the top of the move. Take a look at the Schwab Dividend Index, which tracks a lot of value names. That call for rotation to value was actually the top of the move. That index from top to bottom right now sits down about 5% overall. So you can see there is a lot of rotation happening in the markets. And the goal, guys, is to buy low on the companies that got hit the hardest. And if you're sitting on any value games, possibly the rotation was to sell temporarily. Now, of course, this isn't to say that the next 3 to 6 months won't be the same picture, but if you're a short-term trader, these are the cues that you need to look out for. Financials, mixed, healthcare down, consumer defensives down, and overall, the interest rate sensitive trades were down as well, as today with the inflation print didn't really push the Federal Reserve to have to lower interest rates in a very quick fashion unless the economy degrades. They will still be looking at inflation. They will still be looking at the jobs market, of course, but the yields actually moving higher, and bonds still not reacting to a possible recession scenario. I'll remind you, the bonds really need to skyrocket as they did last August and July when we had a similar growth scare, which saw the indexes pull down arguably an equal amount. Here's the top to bottom move from the mid-January point to the Japanese carry trade unwind. That was a 9.5 move down on the SPY. Similar move right now, 9.5%. The QQQs, similar move as well. Rotation away from growth to value and to bonds because there were real recession fears back then. This was a top to bottom move of 15.5%. The move right now sitting about 13.2% top to bottom overall. The moves are extremely similar. Moving on forward to the one-day relative performance, you can see as much as a mixed market as it was, right? Tech, communication services, cyclicals, energy, and financials rotating to the upside. The other half of the market not enjoying the day. On the 1 week relative performance, though, we still remain down because Monday was quite a brutal day, all things considered. Only energy making it out of the pack with some green. Everything else to the downside. And on a 1 month relative, well, when the SPY is down 9%, guys, you can't really expect any major sectors to be green. Everything is still in the red, consumer cyclical and technology being the worst performers there. So before we get into more technical analysis, guys, let us dive deep into the CPI report and see exactly what happened. So the CPI, this comes after the back of a favorable jobs report, right? Which both helped the markets from stopping the bleeding to the downside. Favorable jobs report yesterday saw that we were not in free fall territory anymore. And with the inflation report today as well went to kind of stop the bleeding, so to speak, in the markets. So overall, jobs report was good, and CPI, very decent. Month over month, 0.2 versus the 0.3 expectancy. Year over year, 2.8 versus 2.9. That's pretty good. And core, 0.2 versus 0.3. And core year over year, 3.1 versus 3.2. So all across the board showed some very decent beats. Now, if we want to break this down into individual components, you will see that if I zoom in on the chart right here, from September, you see October, November, December, and January, all upticks. This is the first downtick in a 4-month read. If you want to break it down into individual components, we can take a look at food. Food, although has been seeing a recent uptick, arguably not that much worse than January overall. If you take a look at energy, another big component, that one is still on a year-over-year basis flat. It is down from January, which January was a 1% uptick from the prior month. Now down about 0.2%, not that bad overall. Take a look at apparel. Apparel also a big component in people's usual shopping baskets with their paychecks. 0.6%, which is roughly in line with historical averages for apparel. So not much to say there. But the big one, guys, still remains shelter. I'll remind you, shelter still representing 60% of the average person's cost of living on a month-over-month basis. Although this is the stickiest component of inflation, it has been trending steadily down for the past year and a half, almost 2 years at this point, since the peak of March 2023. So at least shelter is coming down despite people thinking or feeling rather that it is still somewhat elevated. So those are just a few components, the major components that people like to look at. When we take a look at the normal basket of goods, I always bring this one up, where inflation is and isn't, the 12-month change in a normal basket of goods. Auto insurance, still the biggest component to the upside. Prescription drugs and rent. Rent still a little bit sticky, but look at household earnings. This is a very bright spot in the markets. These are your wages. How much have people's wages increased over the last year? As long as people's wages are increasing faster than the rate of inflation is increasing, you are gaining purchasing power. I know it does not feel like that because it's a very slow process, but the inverse effect would be quite nasty. If average hourly earnings were going down or under the rate of inflation, you would be continuously losing pricing power. So at least it's quite high at a rate of 4%. Housing, still sticky, 3.9. Restaurant meals, education, household energy, very close to the actual inflation rate, and medical care. So several large components still stay above, but a lot of them, guys, are either below or at the average earnings rate of growth over the last 1 year, which is good. We do still have a lot of items that are towards the Fed target of 2% or in deflationary territory. Personal care, pet and pet care, those are big. College tuition, another big one, 2.2. Hotel rooms, groceries, there's groceries, at the target rate of inflation of 2%. This one, 1.9. Recreation, transportation, another big one for a lot of people who use public transportation. Alcohol, used vehicles, and clothing, 0.6%. We saw that one with apparel on the prior chart. And now deflationary territory, new vehicles, airfare, toys, a big one if you have kids, especially furniture, a big one if you're looking to acquire or rather buy furniture after standing off for the last 2-3 years. Gasoline, very big one for everybody, right? Down 3.1 year over year. Appliances, this one is electronics. The title's not there, but down 4.2. A lot of people like buying their electronics for a refresh cycle. And rental cars, 7.1%. So overall, not a bad day for inflation. Now, if you say that the data coming out of the, Bureau of Labor Statistics is fake, well, you can look at some independent resources right here. This is Trueflation. They measure the day-to-day activity in terms of inflation. And as you can see, they have the inflation index rated at a 1.32% year over year, with a large decline from the last day of February through the early portion of March. We do not have that data because the official report, this one, is dated of February. But if the trend continues, you could be possibly seeing, especially if we were to use this source, a decent decline in inflation through the month of March. Now, this data is pretty good, guys. They use 30 million items from 80 plus data sources. They pretty much track the actual sales in stores with the movement of SKUs and their pricings overall. It is updated daily and a lot faster than government institutions. If you want to take a look at the numbers from this Trueflation, you can break it down by their respective categories as well. If you take a look here at the composition, food and beverages down from the month of February into March. This is what this little line right there is showing. You can look at the 1 month time frame if you want to just go from the midpoint of the month of February. We'll use the 1 month for now. Housing, relatively similar, still a little bit sticky, but overall, if you take a look at the or 1 year trend, it is down from the peaks, of course. Transportation from February to March, coming down. Utilities from February to March, coming down. Healthcare services from that spike in February, coming down into March. Household and daily items, a big one for most people, from February to mid-March now, down. Alcohol and tobacco, roughly flat. But then again, that one was not that big of a problem. If you take a look at the Yahoo one right here, it's 1.7 below the Fed's target overall. And clothing, another big one, right? From February, from at least the midpoint of January through the midpoint of February, now to March, down again. Communications, roughly flat. Education, down. Recreation and culture, also coming down from the peaks of the end of the month of February to a more normalized rate. So as you can see, depending on which one you use, whether it's Yahoo's average basket of goods, whether it's the Trueflation basket of goods with over 30 million different items tracked, which is an independent source, or you use the government sources, everything does point that inflation is heading in the right direction. So that is everything for your CPI report. Very decent report for the markets. But of course, we know that recently the focus is not so much on past inflation and what's come out in the month of February. Everybody is continuously focusing on tariffs. For good reason. Those are the major headlines as of right now. But I will remind you, any impact of tariffs onto the consumers will only truly be felt in the economy and on people's pockets within the next 3 to 6 months. So it may be a while to actually get that hard data in terms of the tariff impacts. Now, of course, if the Trump administration were to remove said tariffs before they start working their way into the economy, well, we won't need to have that discussion. But overall, the Trump administration does look firm on those tariffs until they are met, with some negotiations, possibly bilateral negotiations between the different countries that are affected, of course. And we will take a look at that day by day as these stories progress, because we keep getting updates on a day-by-day basis at this point. That is everything I had for the inflation report. Hopefully you guys enjoyed that. Now, let's dive into some Adobe earnings, shall we? Let's take a look at Adobe here. Maybe they've moved because they started their conference call at about 5 p.m. It's about 5:30 right now. Still down about 3.5% in the after hours. Adobe, unfortunately, guys, has just not really done much of anything in the last 4 years. Since December of 2020, arguably holding the same price. There's been some ups, there's been some downs, and more ups. But overall, the exact same price, not seeing much expansion at all in terms of Adobe's chart. Somewhat unfortunate for the company. Their fundamentals continue to improve. However, the growth rates and the valuations, in my opinion, guys, yes, Adobe is a very solid company, but when we took a look at the valuations, especially in this market when so many other names, potentially names with larger competitive advantages and larger moats, are on sale for better prices, that's maybe why I'm not a big fan of buying Adobe right now. So let's move into their earnings. The earnings were fairly decent, 2.15% beat on earnings and a 9.93% beat on revenue. Earnings and revenue have never really been a problem for Adobe. They rarely miss. You can see the EPS expansion curve is very streamlined up and to the right, and the revenue expansion curve is also streamlined and up to the right. They have a very large commercial base of customers, guys. A lot of people that work for institutions that use Adobe's tools. Those institutions, well, they've trained their employees to use those tools already, and they're probably not breaking their contracts. So the recurring subscription rate for Adobe's products, at least on the business side, is quite high. Now, the problem with Adobe as of recently has been their somewhat lackluster efforts in competing in the AI space. We know the AI space right now is all about generative AI. So you type in some prompts into a prompt generator, and it will generate you either an image or even now into video prompts, which will prompt you a nice video made by AI. Now, a few quarters ago, I went through a comparison between Adobe and the arguable industry leader in terms of generative AI for photographs, which is Midjourney. And we were clearly seeing that there was a discrepancy. Midjourney, not having the amount of employees that Adobe has, not having the amount of funding, were able to generate higher quality images on an objective fashion across a number of different subject matters, right? And different content aspects. So is Adobe playing catch up? They are kind of playing catch up despite being one of the industry leaders in the space. But I'll remind you, Adobe's a very broad company. That's not all they do, right? They have a digital media version of the company, or digital media segment of the company, which is 75% of the revenue. That's all their products that you guys know: Photoshop, Lightroom, After Effects, and all that stuff. And then they have a digital experience segment of the business, which is in terms of more business applications, yeah, for marketing tools, analytics tools, onboarding clients tools, and really personalizing an onboarding experience for either business to business or business to client, right? If you're a business that uses Adobe's tools to attract new clients, they will give you the digital experience subscription, which allows you to get in-depth analytics as to how those tools are performing for you, right? So moving on into the Adobe numbers specifically, you can see here from Consensus Gurus, I really like them, shout out to them on Twitter. I mean, beat across the board in terms of this current quarter. The only thing they missed was a ever so tiny miss on remaining performance obligations. How much money does the company have in the pipeline moving forward? A very tiny miss by a fraction of a percent, but still up 12% year over year. You can see the numbers year over year are pretty good. Revenue up 10.3% year over year. EPS up 13.4% year over year. Pretty good. And cash from operations, arguably the best line in this entire report, was up 111%. Very good. Adobe still doing a good job at managing those costs in an appropriate fashion. However, the reason that they're down right now was an underwhelming Q2, an underwhelming 2025 guidance overall. You can see for both segments of the business, media and digital experience, their consensus or their guidance came in under the consensus, misses there, and a miss on EPS by about 0.5% as well. Not tremendous misses, but you know, in this current market environment, Wall Street is looking for absolute perfection, especially in terms of the guidance. And for fiscal year 2025, they also gave a tiny fractional miss on revenue of about 0.2% and a 0.3% miss on, I'll move my big head over here, and a tiny little 0.3% miss on EPS. Overall, guys, not the worst report, but the reason it's down are those incremental misses. I know Wall Street is being extremely picky, at least they have been for the past 3 quarters, but they're looking for perfection, especially in an uncertain market with an uncertain future landscape for consumers over the course of this year and for the economy overall. Is business spend going to keep being high? Is consumer spend going to keep being high? Well, with that uncertainty, when you get underwhelming guidance, it's normal that your stock price simply goes down. Now, a few highlights from the earnings slides before we get into valuation right now is that they are working very hard on improving their Firefly product and their suite of AI tools, because they do recognize that this is going to be the next sales vertical for the company of the future, of course. In addition to monetizing standalone subscriptions for Firefly, we will introduce multiple Creative Cloud offerings that include Firefly tiering. So they're trying to bundle Firefly into the rest of their applications, which is something that a lot of companies have been doing. Google is bundling Gemini into their applications. A lot of companies are bundling their AI features into existing plans for their companies. Kind of as a bonus. They are increasing the prices as a result of that, but they want to integrate it as much as possible so people get familiar with those tools and stay within the ecosystem, right? We will win by focusing on business professionals and consumers, says the CFO, creative and marketing professionals with a unified product strategy and go-to-market. We will start to provide financial visibility into these new 2 groups starting this quarter and expand on this at our Investor Day at Summit next week. They have an Investor Day, their yearly Investor Day on March 18th. So if you're an Adobe investor or just want to get a better glimpse at what they have in the pipeline, just take a look at their Investor Presentation Day on March 18th of next week. Moving into further here, we're going to look at the first segment here, which is going to be digital media performance. As I said, that is their whole Photoshop, Lightroom, After Effects, and all the other products combined, right? So if you take a look here as to the highlights of this, the students, they're looking for faster insights, not only students, but customers overall, looking for faster insights and smarter document editing, of course, with the rise of ChatGPT and other AI bots. Adobe also doing a good job of trying to summarize PDF documents as fast as humanly possible. And the ability to share links and collect comments has increased document productivity and helped drive additional adoption, at least in their document cloud. These new capabilities and our cross-surface investments have paid off, with Acrobat and Reader monthly active usage growing 23% year over year. That is very good. Congratulations to Adobe on that. They expanded Acrobat integrations with Microsoft Edge, Google Chrome, Gmail, and Google Drive, and strong adoption of link sharing for richer collaborative experiences have led to approximately 50% year-over-year growth in Acrobat Web monthly active usage, doing a great job of tying it into all the other services combined, just to make the ecosystem very sticky for Adobe users, right? Strong business and student adoption. Express onboarded nearly 6,000 new businesses in Q1. That's very big, guys, because this is their largest segment of revenue. So you want to see them push and push and push to gain those customers. 6K new businesses in Q1. That is 50% quarter over quarter growth. Fantastic. Students with access to Express Premium grew 85% year over year. Adobe Express, I actually use it myself, guys. I use it to make my own thumbnails. Here you can see my own thumbnails. It's a free web version. It's a freemium, which a lot of people like right now, free. And if you want extra features, you go to paid. This is to compete with other websites such as Canva, right? A lot of people are using Canva right now. They kind of started this whole freemium model, which really made Adobe create this software, this Express software, a web version of software rather. And this one is not that old, guys. It's maybe like 2 years old at this point. They've been doing a good job of that. And apparently people do like it. 85% growth year over year. Key global customer wins include AT&T. Not on this one, but recently Estee Lauder as well. For Firefly, Delta Airlines, Disney, Ernst & Young, IBM, JP Morgan, Microsoft, Paramount, and Qatar Airlines. For that whole digital media segment, right? We also see increasing demand from the next generation of creators who are looking for freemium web and mobile applications as they begin their creative journeys. To better serve these users, we launched a new Photoshop mobile app. Very interesting, and expanded the web experience. I think they'll do quite well with the Photoshop mobile app. Obviously, they want to compete with several products that exist on phones already, such as Apple or Google's image correcting software and AI editing software built into there. So Adobe possibly wanting to compete with those built-in systems on the phones right away. All in all, guys, a very decent report. However, the problem lies in the valuation and in the comparative analysis, in my opinion. So if you take a look here, guys, I mean, 25 billion in buybacks. They still have a lot of buybacks to do. I showed you the revenue and EPS growth curves are very, very smooth and consistent overall. Average price target is still about 560. In terms of the debt, well, they're a very profitable company, bringing in roughly 27-28% net margins. This quarter was no different. It was a fairly decent quarter at the high 28-29 range. And overall, in terms of their balance sheet, I have no gripes with this company's balance sheet or financials whatsoever. Free cash flow is very solid. Cash and cash equivalents that they hold on the balance sheet is very solid. And they do not have that much debt in relation to the cash and free cash flow that they bring in on a yearly basis. However, when we are in this type of market, when the markets are correcting and we have deals all over the place, is Adobe the best deal? That is what you should be asking yourself. It's one thing when everything else is at all-time highs and you're looking for deals, then you can make a case for Adobe. Right now, however, at 430, setting out a price to earnings on a forward basis of 21.13 with a 13.5% EPS growth rate, it gives them a PEG ratio of 1.56 and a free cash flow yield of 4.1%. This free cash flow yield is very solid. The PEG ratio, how much you are paying for the growth of the company, this ratio right here is what allows us to compare apples to oranges, businesses across different segments. And when I see companies like Amazon, which arguably has far more competitive advantages and a much more wider moat than Adobe ever will, currently trading at a 1.5 PEG, I mean, I'll just ask you guys the question. What would you guys rather buy? Would you rather buy Amazon at a same valuation that you're paying for forward growth? Or would you rather buy Adobe? Forget about how much of a percentage off the all-time highs it is. That doesn't matter. What matters is how much you are paying for the growth of a company. And when we compare apples to oranges, comparing Amazon to something like Adobe, or conversely, if you like NVIDIA, would you rather buy NVIDIA at a 1.1 PEG, which is very cheap for the growth that NVIDIA has, or would you rather buy Adobe? Do not measure a stock's ability to run from how much of a percentage they are off their all-time highs. You're missing half of the analysis, right? So the company may appear cheap at a 21 forward price to earnings. However, is it that cheap when their EPS growth rate is only a 13.5? Not so much. So Adobe, great company so far, even though they have their challenges, even though their moat is being challenged by competitors, freemium competitors such as Midjourney, such as Canva. They do still have a very solid clientele in terms of commercial businesses. Their average recurring revenue rates are very high. Their customer loyalty as well is very high as well. They're growing both segments of the business. Very good. Balance sheet is good. Revenue expansion is good. EPS expansion. Is it the best deal for your money right now? And unfortunately for me, for a long-term portfolio, the answer is no. There are some companies with better moats, and I just talked about a few of them, even Google. Maybe you don't like Google because you think that they're going to get broken up by the DOJ or whatnot, so I won't even look at Google. But if we look at some of the fan favorites, such as Amazon and NVIDIA, Well, their valuations are similar or better to that of Adobe, and arguably those companies have much wider moats. That being said, there is a bit of a swing trade here. Stop loss goes below low at about 404, and you're looking for expansion into this resistance area, about 501 up to about 530. So there is roughly a nice 2-to-1 trade if we put a trade profile in this one. That's not the right button. This is the right button. So there is a nice little trade profile here if you're looking for expansion, about a 2-to-1 trade. But for a long-term portfolio, I'm a bigger fan of buying some of the other companies that are currently at nicer discounts or equal pricing. However, they have much larger competitive advantages. And that is everything for Adobe earnings. Hopefully you guys enjoyed that. Now, diving into the indexes, guys, shall we? So as I was kind of hinting at earlier, Fear and Greed Index ticking up from a 15 early on in the week to a 20 right now. Extreme fear is still broad-based in the markets with momentum below most major moving averages. Even the SPY still below its 200-day moving average. No secret there. Stock price strength, net new highs and lows on the New York Stock Exchange. What stands to argue, when everything is down and nothing is hitting new all-time highs, well, the lows are going to be a lot more prevalent, right? Still in negative territory right now. Stock price breadth, we saw the heat map overall. 1 month, the damage is done. And even on the 1 week, the damage is done. So of course, there's not going to be much breadth in the market overall. We can even take a look at some of our breadth indicators, percentage of stocks above their 20-day moving average at a 19. I'll remind you every time, take a look, guys. It's not just me, right? I'll even put it on a weekly time basis. Every time over the last, how many years? 15 years that we dive into a 20 to 14, it can go lower. It has always been a great buying opportunity in the markets. Percentage of stocks above their 50-day moving average. We can do the same analysis. Take this chart all the way back. Can we go lower? Yes, but we shouldn't be trying to time the absolute bottom of the market. We know that for the most part, that is a fool's errand, especially when looking to add to long-term portfolios. Swing trading is a little bit different, but for long-term portfolios, has there ever been a bad time to add when the charts clip into a 24, 25 in terms of stocks below their 50-day moving average? No, it's been a great time to start buying the pain in the markets, and percentage of stocks above their 200-day moving average. Well, we're not at the lows because it's not a broad-based market crash such as COVID, such as the depths of 2022, or even the inflation concerns of late 2023, but is it a good time to start buying a lot of companies that are under their 200-day moving averages, that are very high quality, high conviction companies if you're holding them for the next 5, 10, 15 years? Absolutely, at a very low read of 35. So I do like to take advantage of this fear. And speaking of that fear, right, the SPY right now, in terms of our price action, nothing has really changed since yesterday. Still looking for a short-term bounce out of support right now. 565 down to about 553 is the range. As I was showing you with the volume, this was the volume climax into the most recent few days of fear. And now the volume from today, at least under the most recent 7 days. So starting to cool down in terms of the headlines right now, in terms of the fear, in terms of the volatility, slowing a little bit down. When we take a look at the VIX later, you'll see that the volatility is starting to slow down a little bit. So that being said, might just be due for a bounce, but always remember who's in control here. These short-term bears are largely in control. Any bounce just looking for a lower high, we will have to measure how high is that lower high going to be. One thing's for sure, 577 up to 585 on the SPY is resistance. So it's up to the bulls to reset the daily uptrend pattern. Could we be seeing a short-term relief rally? Quite possibly off of the back of favorable inflation reports. And if there's some favorable news that comes out of the Trump administration, such as relaxing of the tariffs and negotiations between some different parties, maybe Russia coming to the table to negotiate the ceasefire deal with Ukraine, well, those are all things that in the next few days may alleviate some pressure and lead the bulls to have at least a few days of rally before we take a look at how high the bounce actually gets. Moving on to the next one, QQQs, same concept, right? Same concept overall. Taking a look, looking at the bounce out of daily oversold conditions into support 483 down to about 468. This 15-point range, which was all these guys down there, bouncing fairly nicely, guys. This is a very decent level below the 50 weekly EMA out of daily oversold, as I just said. The volume climax the last 2 days. I mean, look at that volume. That volume was absolutely nuts on the Monday session. Volume climax, gap down into oversold conditions. Usually those are conditions that you do find a temporary local bottom. So we will remain to see, can that bottom be maintained, or possibly will we just roll over on any more tariff or Trump administration headlines overall? We'll take a very close look at how the market evolves, but daily downtrend is set, looking for a lower high. Some people call it a dead cat bounce. All it is just price action, looking for a lower high. Then it's up to the bulls to tell us, Can they reset a daily uptrend and start attacking some of this weekly damage? Well, we'll see, guys. We haven't even got the first leg of the bounce underway. So we'll take a look at this day by day, but definitely a fantastic opportunity to be buying some of these stocks, guys, into the long-term portfolios if you like them for the next 5, 10, 15, 20 years. And we will take a look at this day by day. I'm not saying it cannot drop lower, but am I saying this is a great time for first entry and then this will be a second entry? Absolutely, but we don't know if it's going down there. A lot of people think it's going down there, guys. But if you say that you have a crystal ball and you know, you'd probably be a billionaire by now if you can predict every single move, right? You would be a multimillionaire if you know that this is not going to be the bottom and you know it's going down there. Well, you also should have known that this was the top and you would probably gone all in on puts and you'd probably be driving 4 Lamborghinis right now, right? It's not that easy. Moving on to the XLF right now. XLF, right, 0.15% to the upside today, starting to have a nice little bounce as well. Daily oversold conditions into support, which is 48.30, down about 46.82. Did not quite touch the 200-day EMA, reacting from support, and also did not fill the election gap, which would be 46.66. So the XLF has a little bit more room to the downside, but if the bulls react, we'll be looking for a lower high. Then it depends. How high do we get? Can the bulls set a new daily uptrend with a 50-60% retracement size? Just always use the fibs. If you can't eye it out, use the fibs. 50-60% retracement size gives the bulls the best chance at resetting into a daily uptrend. You get a very weak bounce before rolling over. You are definitely retesting these lows and possibly going lower. If you do go lower, areas of support remain 46 down to about 45.33. Moving on to healthcare right now. Healthcare, daily downtrend underway, flushing below this used to be support now it's resistance, 148.80 down to about 146.40. This little 2.5 point range, let's call it, big level, prior resistance here, resistance again right now, and now almost in jeopardy of forfeiting the weekly uptrend. The weekly higher lows are set at 143.89. You close the weekly below that, you've officially lost the weekly uptrend, and unfortunately, you know, it was an inverse head and shoulders here. They went for the expansion, got rejected with the most recent headlines. Now you got the bigger head and shoulders, right? So a head and shoulders within a head and shoulders. Healthcare, can we possibly roll over? Yes, but where would the damage be limited to? Well, all this congestion area, guys, talking about 140 down about 129. That may be a better area for you to go shopping for any of your favorite healthcare names that you've been waiting for some discounts on in a while. They may just be coming right around the corner. Moving on to semiconductors right now. Semiconductors trying to bounce a little bit. And the key word is a little bit. I know it's a 3% move, but in the context of this downswing, it's not that much, right? Daily downtrend is maintained. It is clear as day right now. Lower highs are set 230.31. Now, in terms of the fibs, this is a very decent retracement size, talking about a 618 retracement. That's what you want to see. Now, can the bulls convert? Can we either get more of an engulfing move, which increases the odds of recapturing a daily uptrend, or will we roll over here and the bulls have to play some defense and get the daily uptrend back? Because if not, still just looking. A bounce is only a bounce until you change the trend, right? Still looking for a lower high. It's up to the bulls to prove it to us, but nice to see that we're back into the support range. 232.65 down to 218.62. If ever we flush and undo this move from today, going right down to about the 200 psychological level, and that would be a weekly downtrend. Big move down here, and then this entire zone. I haven't changed this from green to red because we have not closed the weekly candle below it yet. That's why it is still support. The bulls are still using it despite breaking below and flushing. They are still not closing the weekly below it. So remains to be seen. Can we hold? If we break down below, this whole area becomes resistance. Then it's going to get a little bit dicey, in my opinion, onto the IWM Russell. So the growth names still struggling, but can we be seeing possibly a volume climax bottom as well? Well, quite possibly. The volume climax was had on the Monday session, or rather Tuesday yesterday for this index specifically. Can we possibly see a local bottom being formed with daily oversold conditions? Yes, it is a distinct possibility, and I think the bulls have a good chance, but keep in mind, any bounce, what are we looking for here, guys? Just looking for a lower high. And what's above us right now? Well, unfortunately, huge resistance. 217 down to about 208 is going to be a very large area of resistance. The lows of 2021, resistance as well, congestion, support, which is now resistance. So just looking for a weekly lower high, then it's up to the bulls to prove it to us. Can we get a weekly trend change? This chart is weeks and weeks and weeks away from confirming a weekly uptrend to confirm any long-based trades. At this point, the bears are going to have fun because any bounce into here is just a short opportunity to possibly revisit the lows. But is there a chance of them resetting? Yes, but only if the overall markets reset as well and the risk on sentiment comes back. And I do think after we covered this on Friday, all the market catalysts and volatility events right now, none of them can be taken off instantly, right? These are all things that will take time to alleviate or be alleviated from the market in terms of sentiment, in terms of narrative, and overall just in terms of the size of the things that we're looking to kind of undo in terms of the damage, right? So the risk on trade should be quite a while until it comes back. Right now, moving on to the Dow Jones. The Dow Jones also trying to find somewhat of a local bottom, was actually red on the day today into daily oversold conditions. Do we have the volume climax? Well, we'll take a look. Oh, not on this chart, unfortunately. It doesn't give me the volume profile here, but pretty sure it's kind of the same concept, right? So that being said, looking on to daily downtrending territory right now, not going to close the support box because we did not close the weekly candle below it just yet. Although they have a very good chance of closing below it, I'll still give the bulls the benefit of the doubt in case they want to rally the next 2 days and close within the confines of support. But as of right now, you can clearly see, right? Loss of the weekly uptrend. We try to get it back, right? This was weekly downtrend, tried to get it back. Well, we never got it back, right? So unfortunately, weekly downtrend is simply maintained at this point, just looking for a bounce out of support, which is currently 41.3 down to about 40,500. We'll keep our eyes peeled. The Dow will only bounce if the rest of all the indexes bounce and we start getting some more broad-based market bounces rather than just, you know, a lot of sectors down, one sector up, and then vice versa or whatnot. The Dow Jones needs cooperation from everybody, but overall, the market's trying to find somewhat of a local bottoming out process. We took a look at the VIX yesterday. We'll take a look at it today. Again, down about 10% top to bottom from the highs. Well, actually more from the highs of yesterday, but from the close of yesterday. Now from the highs of yesterday, down about 19%. I did take a VIX trade. I didn't get the absolute highs, but we were kind of close. We kind of shorted the VIX because when you know the VIX pulls into the $30 range, it's usually a good first entry for a short attempt after a 4-week rally in terms of volatility. So the VIX also coming down. Could this also be signaling that the markets have approached somewhat of a local fear bottom? Yes, indeed, but still too early to tell. We are still somewhat elevated on the VIX. Moving on to the 10-year yields, well, you can see this is the recession trade, guys. If the fears by big money was truly for a recession, well, all of this selling, institutional and retail alike, but especially institutional, all of the institutional selling, where are they going? Well, are they going into gold? Well, not really. Gold's had a nice rally the last 2 days, but where have they been the last 4 weeks? You would expect gold to be absolutely skyrocketing right now. It is not just yet, and gold does not perform too well in the context of recessions. You only need to go back to 2022 to see how much that was the case in terms of gold. Gold did not outperform during the asset recession and valuation compression of 2022. It also did not perform too well at all in the recession of 2008, which is this picture right here. Gold was down at that point 31%. There, you know, gold can be a hedge, but is it a recession hedge? Debatable. No, it has never really been a recession hedge overall. The bonds definitely are, though. The bonds, in my opinion, are the smoking gun. If I'm looking for a smoking gun to determine whether or not this fear-based sell-off is truly a pivot towards recessionary concerns by big money, you have to look at the bond performance. When we got the last one in the month of July into August, when we had that growth scare and recessionary concerns, look how the bonds rallied. This is a recessionary rally in your 20-year bonds as people flock to absolute safety after the Japanese carry trade unwind. We have not been seeing that move, guys. When did this move down on the SPY start? I'll show you, right? It started the 21st of February, has not stopped ever since. How have the bonds responded? The long-term yields especially, which provide the best amount of yield for your money. Well, the bonds, this is the 21st of February. As you can see, we are only up from that point. Sure, we went higher, but why are we not extremely higher since the last few days have been very volatile? Since the 21st of February, we are up 1% on 20-year yields. In my opinion, a little bit of a smoking gun. Maybe bond traders are just late to add to that protection. Maybe everybody's just sitting in cash. But I think you guys know by now, institutions do not sit in cash. They have to have their money constantly working for them because they have clients. So the 20 and 10-year yields spiking up today. Still no sign of the weekly downtrend rollover. Still looking for it. That weekly downtrend rollover. Still looking for the 20-year rollover. And in terms of the rate cut expectations, guys, definitely not pricing in a recession just yet where the Fed would have to cut interest rates in half because things are getting too poor. The market's still largely anticipating 3 interest rate cuts right now. and it's oscillating between 2 and 3 in the last couple of days. So, you know, the markets have priced in 1. Can we be getting 2 or 3? Quite possibly, but definitely no panic in terms of institutional selling and pivoting into bonds just yet. As I said, it's a very complex trade. Maybe there's a delay on it. Maybe there's a lag. We'll see. We'll take a look, but I do think TLT are a pretty good bid here, at least for the next 12, 18, 24 months, as rates will come down either way. If the economy's good, rates are going to come down. If the economy's bad, they're going to come down faster. Moving on to Bitcoin right now, bouncing a little bit on the day is Bitcoin. So Bitcoin with a decent little rally day, 5.56%, you know, just a little 5.56, but who's in control? Still the daily bears looking for a lower high into the moving averages and into resistance 88 up to 92. The bulls with a lot of work to do. Number one, have to change the trend because as of right now, those bears are going to continuously short every single lower high and try to go for the absolute flush into support, which is currently sitting right now 73 down to 67. I don't know if it's going to come down into there. Depends if the overall markets have more pain, but the short-term bears are in control. The weekly bears are also in control, and we are below this area of resistance. So before we have any longs, you need to find the daily uptrends. As of right now, no daily uptrends just yet. And on the rest of crypto, guys, unfortunately, is just not going to do anything until at least Bitcoin recaptures the daily uptrends and then makes a move to recapture the weekly uptrends too, or at least gets back in the confines of the safety range above, and this level of speculation gets taken off of the table. Now moving into our big tech name, shall we? All right, so moving into Apple right now. So Apple, after pretty much holding up better than most, unfortunately in the last few days has started to unravel, battling with the last line of defense right now at 215. Apple down from the all-time highs. Now, similar to its peers, 16 to about 20%, which is kind of what the rest of big tech is doing as well. The bears in full short-term control and now finally approaching daily oversold conditions. Apple has usually found some sort of a bounce from daily oversold conditions, at least the last few times that they've made their way into it. There are certain exceptions where we can see ourselves get deeply oversold, such as during the March 2024 sell-off over there. But overall, if the markets tend to bounce, Apple might just follow suit, now trading below the 200 EMA. And this line, unless broken, unless the weekly candle closes below, is not yet going to be resistance, but it's not looking the best, right? Weekly downtrend, if we close like this, will be in motion, and that would just mean you're into monthly further consolidation for Apple. If things truly get dire for Apple, I've told you guys where we might be going on Apple. You might just be going back to the 200 psychological level of resistance, 200, or rather support, 200 down to about 195 is the next area in terms of a break to the downside. If you want the bulls to recover, very simple, just like the rest of the market, the bounce needs to come. When you have the bounce, measure the size of the retracement. 50-60% gives the bulls a good chance of recapturing this entire support zone, the 200 EMA, and trying to go for the daily uptrend shift. But as of right now, I'm not buying Apple. Why? Well, quite simply, guys, it's a question of valuation. The PEG ratio right now at, you know what? Let me redo this at 220 right now. Let's be fair. Let's do it at 220 rather than me just saying what it should be, right? So if we redo this one at 220, right, 220 divided by their forward EPS of 733. I don't think that's moved by Wall Street recently, but we'll have a quick little glance. 2025, 731. All right, it's moved by 2 pennies. That's not going to change the calculations by much at all, but we'll do it with the updated numbers, right? 220 divided by 731, you're looking at a forward PEG ratio of 30.09. So let's just readjust that right there with an EPS growth rate of 10.5% per year, which is generous for Apple. They're growing services. They're always growing free cash flow as well. You divide that by 10.5, you're still sitting at a 2.86 PEG. One of the worst valuations in all of big tech for some of the slowest growth as well. So that is why I'm not buying Apple, nor for a swing trade, nor for a long-term portfolio buy. Fantastic company, but once again, the status of a company being fantastic doesn't necessarily mean that their share price is fantastic. And for me, the share price of Apple remains a bit expensive. Moving on to AMD, a company that's not expensive right now. AMD having one of their best days in recent memory. This company was up 4.16% today, but still looks like it's doing absolutely nothing. Need to break the highs of last Tuesday, the 4th of March. 103.6 is the mark. If you want to reset this into a daily uptrend, the bulls doing a good job of protecting the last line of defensive support. 97 up to about 112 is going to be that area. First things first, give me a daily uptrend. And then when you have the daily uptrend, we have to measure the size of the move in terms of the weekly retracement, because we know who's in control here. Well, it's definitely the weekly bears, and the lower high is right here, 116.54. Give me a nice 60% plus retracement on the weekly, and then we can talk about the capacity to reset the weekly uptrend and attack the higher area of resistance, 120 to 134. But as of right now, AMD is still on paper one of the cheapest names that I go over on a regular basis. At about 108, their valuation is a 0.57 peg. Their forward revenue and EPS guidance is very good. If you take a look, this should be some of their best years in corporate history. Average price target is 148 still, even after all the declines. Look at the EPS expansion, look at the revenue expansion, and gross margins and free cash flow should be expanding as well as net margins. So a very good company in terms of a risk to reward profile. But notice I say there's not no risk. It's just the reward at this point, in my opinion at least, is outweighing the risk. If ever they fall through, the next big area of support is 85 down to 70 bucks. Moving on to Amazon right now. Amazon not performing too poorly at all today, up 1.17%. But at one point today, they were up about 2.25. Similar things, right? Coming out of daily oversold conditions, reacting from the support zone, 197 down to about 186. Bouncing up nicely, getting rejected by the 200-day EMA. The daily bears are still largely in control of this chart right here, but a nice little bounce. Lower high is set at 209.68. As of right now, the size of the bounce remains about a 50% retracement, a little bit more in terms of if it can get up to 203, 204. That would give you the 618 retracement, gives the bulls a shot at resetting the daily uptrend and undoing some of this weekly damage. But we know it takes a very long time after a move like this, which was similar proportions on Amazon. 22% July to August. Now, well, 21%. Very similar. Look how long it took them to get the move back here. It takes a very long time, right? So you cannot call it just yet, but it all starts with a decent size bounce. This bounce size, you zoom in, how much was this bounce size? Top of this candle, 618. So watch the size of the bounce if it is indeed coming. If not, if they set a too shallow lower high right here and just roll over the daily uptrend, we're just revisiting the lows. I'll remind you the closest area, the bottom end of which is 185 support. Moving on to Google right now. Google up about 1.82%. Same concept as Amazon though. Daily downtrend is still largely puts the bears largely in control. Bottom end of support, we clipped into it. 163 on Google. Fantastic, fantastic location to be buying Google, but similar to the July to August sell-off, which saw Google come down 22. Google is now down, funny enough, 22. It takes a very long time to get the weekly uptrend back, but it all starts with the daily uptrend first. So we will take a look. If the bulls can bounce and get as close as possible to 176.40, get us the daily uptrend back, then we can talk about the size of the weekly bounce. And if we can get the weekly uptrend back, similar to what we did all the way back there, Google's still one of the best valued names in all of big tech. I will remind you of the valuation at 165, where we were the other day when I was screaming, if you like Google, then we should probably be buying here. Only if you like the company, right? 1.23 peg at 165. That is dirt cheap for a fantastic company like Google. Moving on to Meta right now. Meta up about 2.29%. Not too bad overall of a day of performance for Meta. Their valuation at 592. So now it's going to be a little bit higher. The best valuation was the other day down here at a 2 peg. So the company is still trading relatively rich in my humble opinion, but respecting the levels fairly nicely. 600 down to 575 was the area of support. Resistance, support should be newfound support, and indeed it was. The bears still in full short-term control though. Lower high is set right now at 657. Size of the bounce, not too bad at all. You're looking at a 618 retracement. However, we are into resistance right now. So if the bulls get rejected, it's up to them to then set the daily uptrend in motion and start recapturing a lot of this weekly move. We have not lost the weekly uptrend. If I zoom in, you will see we have not lost it. The higher low is right there, 591. We have not lost that low. It came very close, but never closed down under it. So we can get it back. However, guys, V-shape after a 100% engulfer, highly unlikely. What's more likely is either a tightening range or a 2-step recovery process. So we'll keep an eye on this one for Meta over the next few weeks, but nice to see the bulls trying to find a local bottom. Moving on to Microsoft right now. Microsoft, same concept, up 0.74%, but doesn't matter, right? The bears are still in big control. Lower end of support, 378 down to about 364, reacting from it very nicely. This was these guys all the way back there. And we did clip into almost, oops, my head's in the way. Big daily oversold conditions, almost on Microsoft. The lower high is all the way here, 401.25. So same rules apply. Watch the size of the bounce at this point in time. And I'm not closing I'm not closing this box red just yet on the weekly. This is a weekly level, large weekly level. We have not closed the week. I know it doesn't look very good, but until Friday, if Microsoft somehow bounces and closes a candle into 398, I'd be surprised. Crazier things have happened though, but that's why I'm not closing it just yet. Like, we know that yes, into this area, approaching it will be big resistance. So you need to have a nice bounce, give the bulls the best chance at trying to recapture the level overall. But Microsoft, very decent valuation down here overall. Microsoft trades somewhat relatively rich most of the time. At 380, you're looking at a valuation of just around a 2 peg for one of the most solid and high quality companies in the world. You're literally getting December of 2023 pricing, guys, like a year and a half almost at this point, November 2023 even, right? Is it a good time to add some Microsoft to a long-term portfolio? Yes, and a matter of fact, I did myself. Moving on to Netflix too. Netflix up about 2.75% today. Coming into resistance though, 936 down to about 898 is this resistance area. The bears still remain in control, but right now this is a decent size bounce. Take a look at the size of the bounce. It is a 50% bounce. If you can get a little bit higher, you can then maybe reclaim this area of resistance overall. They close the weekly below it. Can we get it back? Netflix, contrary to a lot of other names, never lost the weekly uptrend, tagging the 26 EMA. Can the bulls get it done after an 80% retracement size, blast the all-time highs? Somewhat unlikely, guys. More likely is a tightening range. Worst case scenario is lower high into lower low, into a big head and shoulders, and into further monthly consolidation. But we're not there yet. We'll take a look at this one day at a time. Am I a fan of buying Netflix here? Yeah. Maybe if you don't have it already, but if you have some shares from, I don't know, any point all the way back here, personally, I do, and I'm not adding any, even though the valuation at 860 clipped into a 1.51 peg. If it's a first add to a portfolio that you're looking to hold for the next 5, 10, 15 years, yes, but keep some money so you can DCA on the way down if ever it pulls down to my true desired buy location, which is kind of under 800. We'll see if it happens. Moving on to NVIDIA, however, NVIDIA up 6.42%. So even NVIDIA with a very large bounce, it doesn't really look like it went anywhere, right? But a bounce is a bounce. I'll give it that to them. Daily downtrend is clear as day right now. Lower high is all the way up here. You'll notice no new highs. So there is no lower high in any of these candles. This is your lower high. Daily downtrend, leg number 2, 135 is lower high. The bounce might seem nice right now, but this is only a 38.2 retracement size. If we roll this over as of tomorrow, we are highly likely to head back to the lows or maybe even lower and continue off with one more leg of selling. I'm not saying that's what's going to happen. I'm just telling you how the price action works and why the size of a retracement is very important. You would like to see NVIDIA come all the way up into the resistance range, 125 to 133. That would be a 60 or 70% retracement, and that would give you a very good chance at resetting the uptrend and smashing through this box of resistance. That being said, reacting nicely from support 111 down to 102. If for some which reason you flush the 102, you're heading down to the next big location, which unfortunately for them is 95 down to $81. A very decent sized bounce for the company. And if you didn't take the hint earlier, the valuation at 115 is very cheap, arguably the cheapest it's been in a very long time, as the company has grown its fundamentals all through this sideways consolidation, which has been lasting at this point, guys, for almost a year. Sure, we've popped above, we've popped below, but no price change in the last year while improving fundamentals drastically. We went over their earnings and they were fantastic for guidance for this upcoming year. Before last, moving on to Tesla. Tesla bouncing 7.5% today. Very nice bounce. Sentiment on the company and, just technicals overall, we're both oversold, right? Sentiment in the absolute trash for many reasons you guys must know by now. And to the flip side, technicals rather, 21 on the RSI was the bottom after the 15% drop on the Monday session. Nice bounce. However, who's still in control here? Well, the daily bears are still clearly in control, right? This 1 day of bounce or even 2 days of bounce is not much. Take a look at the size of the bounce right now. It is a 38.2 bounce. If the bulls get rejected at resistance, 258 up to 301, the bears are just going to look to short this one back into the lows. You need to see a 50-60% move and then reset of the daily uptrend. Only then will you know the weekly pain is possibly over, and you're just looking at that point for a weekly lower high to possibly reset to a weekly uptrend. The bulls have a ton of work to do on this stock right now, guys. I will redo the valuation on Tesla as well because I keep cutting it in half, right? I'll redo the valuation 291. So it's even down from, oh, that's not going to be too good. 291 for EPS on a 2025 forward basis at 250, which is the price right now in the after hours at 250. You guys ready? And I'm a Tesla shareholder, and I'll tell you guys, this is very expensive. 250 divided by 291. Say 86 forward peg to earn forward price to earnings. Now, you might say, yeah, but it always trades rich. And I agree with you. Yes, it does. But the fundamentals, have they been getting better or worse over the last year? Arguably, they've been getting worse, right? Car revenue, auto revenues, curling, deliveries peaking out, right? It's not as if the fundamentals are going 10x every single year anymore, right? So 86 forward price to earnings, and you divide 86 by a 20 EPS growth rate, you're still sitting at a 4.3 peg. That is still high, guys. It is literally still high right now, right? So even though they have a ton of long-term positives, they have a lot of short-term negatives as well. And that is the analysis for Tesla. I might only be interested if we possibly see a crack of 200. I'm not saying it's going there. I'm just saying if it breaks 200, that's when I actually get interested. A little bit too much short-term negatives for me right now. Are there some possible swing trades to be had? Sure. They try to make the daily high or low attempt, right? And then the stop loss will go below there, and you're targeting the most recent high. This would arguably be, on a retest, a 2-to-1 trade, maybe even a 3-to-1 trade if your stop loss is there, right? Moving on to Palantir. Palantir, nice little bounce today as well, 7.17% to the upside. The daily bears, though, are still in full control of this chart, looking for a lower high, anything below $90. Looking for a lower high, nice little bounce, though, protecting the area of support, 84 down to about $77, holding on to it. The bears have never claimed the weekly uptrend. This is still to the bulls. Weekly higher lows are set at 64, possibly looking for some expansion, but do the bulls have it in them to go back to 125? Debatable. This is a very large retracement size. I put the fib on it the other day, right? This is a very large 80% retracement size. Usually when you get 80% retracements of a move, the likely outcome is not just a V-shape to all-time highs. It is either a consolidation range and then break to the upside, maybe in or around the earnings in May, or the worst case scenario, it's a lower high set up for a lower low, which you might see Palantir dip back down to $72 to $63. We'll take this one day at a time. Bit too expensive for me, and I'm saying that as a Palantir shareholder, guys. Even at $78, it's a 5 peg and a 29.5 forward price to sales, and that is with extremely bullish revenue and EPS growth metrics as well. And I'm being very fair, guys. I'm a Palantir shareholder. My shares are down here at $12. I've made my money, so I think I'm in a position to say whether or not it's expensive or cheap in light of its future growth. I know the future growth profile of the company. That being said, it's not cheap. Moving on to SOFI. SOFI also not looking too bad today, trying to find somewhat of a local bottom, daily oversold conditions, volume as well, bit of a volume climax in the last few days of trading, trying to gain back the 200-day EMA into support 1170 down to about 950 at the bottom end of the range. SOFI not looking too bad, but same as the rest, right? Watch the size of the bounce. They need a 50-60% retracement size. Try to reset the daily uptrend and attack this area of resistance, $14 up to $16. The whole time, though, right now, it's a weekly downtrend. So first things first, give me the daily uptrend back, and then we can talk about setting up for a weekly uptrend shift. As of right now, it is just monthly consolidation into a very wide range of support for the company. Let me turn volume off so you guys can see it. Very wide range of support. I'm a big fan of buying more SOFI. 11s down to $9. If they keep giving me some opportunities, I'll keep writing some short puts. And that is pretty much everything for the analysis for today. Hopefully you guys enjoyed. Yesterday, towards the end of the video, I went through a bunch of other swing trades. Saturday as well, I give a bunch of other trades. They're all still on the table, but hopefully you guys enjoyed today's video. If you did, consider dropping a like. I would really appreciate it for the growth of the channel. Consider subscribing if you're new. We do these every Monday to Friday after the close. And as per usual, if you have any questions, always feel free to ask them down below in the comment section. I answer every single one of your guys' questions, and it's always a pleasure to do so. And in the event that you guys want to join our private trading Discord overall, we have all of these swing trades, essentially, all of the trades, the long-term portfolio trades that I do on a daily and weekly basis. Here are all the trades from the inception of the Discord. The green check marks are wins. The little red circles are losses. We do the wheel trades, the call debit spreads, the put credit spreads, leap options, long-term portfolio trades, share swing trades. There's something for everybody. If you have a small, medium, or large account size, I'll be glad to help you. You can follow my trades, or I can also opine on your own trades and your own positions as well as your long-term portfolios, right? Not financial advice, just my 2 cents and opinion. We do live streams in the morning every Monday to Friday for about 2 hours where I answer all your questions live, trade live as well. If you can't be there, they are all recorded too, or you can ask me your questions in our chat rooms. We also have private videos that I don't show on YouTube, advanced option strategies, how to grow small accounts into big accounts and quit your job and trade potentially full time. A lot of those videos have been providing great value for members, and you get access to all my charts, all my watch lists, all annotations with the click of a button. If any of that interests you, the link is always down below. Would love to have you in there. And if not, I guess I'll see you back on the channel, guys. That's it for me. Take care. See you tomorrow, and peace.